26 years of CNBC-TV18.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and as we speak, well, the market's a little bit under pressure, down close to around 100 points or thereabouts. And Mangalam, it's the 26th birthday, so we continue to be in good mood, and keep it going.
That's good cardio, Nigel. Perfect for the wake-fit guys who will come later for the IPO, because once you're tired, you'll probably get better rest as well. But be that as it may, I'm sure when you joined CNBC-TV18, you weren't 26, were you?
I was younger than 26.
Yes, same here, Nigel. And, it's so good to see the channel turning 26 and we remembering that we feel 26 still, oftentimes less than 16 as well. But be that as it may, what a brilliant journey this has been for us, the channel, the viewers, and we have no one to thank but our leadership, but more importantly, the viewers who've been constantly giving us incredible feedback, constantly nudging us as well. Guys, you asked that question wrong, so why not improve upon that?
Yes.
So we've tried our best, and from Nigel and me, all we can promise is we'll continue to do our best for the next 26 as well.
Well, that's right. Feedback is what makes us. You all have made us, so we are happy to be out. Yeah, and Mangalam, I was just looking at the records today, and I think, I joined in as a, as a trainee, as a junior out here. And I think as of now, in terms of male anchors, I think I have the record of the highest number of years male anchor at CNBC-TV18 in 15 years. That's a record maybe you break in the time to come.
Let's see. I know we'll do this together, Nigel. And it's only poetic that the Nifty is at 26,000 when we turn 26 as well. But let's talk about fueling the market ahead and fueling our cars as well. Our colleague Sonal spoke with HPCL's Vikas Kaushal and discussed multiple factors, including the impact of rupee depreciation, the company's crude sourcing strategy, and the updates coming in on the demerger of their lubricants business. This is HPCL that we're talking about. Let's hear out that conversation, come back, and then after the break, we'll have the management of WakeFit joining in.
Depreciating rupee is more of a macroeconomic situation. We've touched 90. Obviously, the increased rupee to dollar has an impact on crude imports. Companies like us import a lot of crude, but still the depreciation, if you look at it, has been in range of a couple of rupees, which we've been able to absorb. On the second point you said about diesel cracks, etc., well, that is a demand-supply phenomena. In our industry, that really is dependent on global demand supplies. The diesel crack, as we see, are actually globally published numbers. We look at Dubai cracks and others, and we follow those. Now, for an integrated marketing company, refining and marketing actually does not impact. What impacts me is the price of my crude and the price of my product. For anybody who has a balanced portfolio on both of these, if your crude, the cracks are higher, you earn higher refining margin, you earn slightly lower marketing margin, but net you earn roughly the same amount. At HPCL, we have a slightly less balanced portfolio as compared to some of our peers. We have refining of about 25 million tons on our own, plus we have some joint venture refineries, but we sell more product, and hence we are a net buyer. To some extent, it impacts us, but then this is something which we are very used to in our business. We plan around it, and I don't see that as a major concern. Yes, there was a spike to even early 30s on diesel cracks, but those have started cooling off right now, and it does not make a massive impact on our numbers. The good part is we are also coming very close to balancing more of our refining and marketing portfolio in the next few quarters.
Mr. Kaushal, you mentioned that what matters at the end of the day is crude sourcing and the product prices. So let's talk about the crude sourcing, because there have been a lot of developments there. Is HPCL not buying any more from Russia and adhering to the following the sanctions that came by? And what is the crude basket looking like right now?
Yeah, I think, Sonal, there are two parts to that question. Are we adhering to the sanctions which are there? I think every law-abiding citizen, every law-abiding company follows the international decorum, international rules in this entire thing. So we also follow that. The rule prohibits companies like us from, the sanctions prohibit companies like us to buy from select companies. We are not buying from those. Remaining everything is an economic decision which we take on a regular basis. Just to give you a bit on how we buy crude, Some of our crude is bought on term agreements, which are like an annual agreement where we commit to volumes and we commit to time periods when the cargoes are going to come over. And remaining is bought on spot. The term is anyway done at the beginning of the year. In fact, right now we are thinking of how we do the terms for the next year or planning that. On the spot, every month we go to the market a couple of times and buy what are the best available cargoes to us from an economic decision. At that point of time, we see what is fitting in our crude basket, what crudes we have available, what is needed in our refineries, what can we run at this point of time, and what will make the most economic sense there. Again, if I just look at the global crude situation, you would have seen the crude prices have been reasonably stable despite the upheaval around geopolitics. They have been in mid-60s all this while, which points that there is a reasonable amount of crude which is available. At HPCL, we have technical capabilities of processing anything up to 180 kinds of crudes globally. In any year, we would evaluate up to 100 plus crudes, which we take, and many of them, a subset of them, we run in our refineries there. So every time we go to the market, we look at 30, 40 different crudes, see which is economically fitting into our scheme of things the best, and buy that particular thing. We see enough crude is available. Our basket of buying crude is wider. We have bought crude from South America. We have bought crude we recently bought it from US. We have brought it from Guyana, a lot of Western African crude, and then of course the Middle Eastern crude. So there is a different variety of crude which is available, and all those options are available. Plus we also run the indigenous crude which is produced in India. So we are quite comfortable on that. Thankfully the prices on crude have been reasonably stable, which gives sort of a predictability to our business.
Got it. The other part of the business is the lubricants demerger. Analysts were quite positive on that, but there is some postponement on that. What happened here?
Yeah, I think that's a very interesting question. Every analyst call I get asked that question. 2-3 years ago, HPCL board, I wasn't a part of the board at that time. I wasn't in the organization then, but the board then decided to demerge the lubes business and float it separately. In the last year after I came on board, we've had a chance to think through that particular strategy, and we believe that there is a lot more we can do by building that business internally at this point of time and unlocking the value at a future period of time. So let me say we have prioritized our efforts on building a stronger consumer brand. So if you see a lot of advertisement, if you're watching the India-South Africa cricket, you would see the Virat Kohli century with the HP Lubes advertisement in the background. So those are the things we are doing in strengthening that business, because we believe lubes is a very interesting business for us, where we can create, we already have a strong brand and we can create a bigger consumer facing business, and hence create a greater potential around that business. So it's just I would say a strategic call that we believe the business can be built better internally at this point of time.
Got it.
And maybe when the decision was taken, we needed it more. It was more of a financial call also. Fortunately, in the last 12 months, we have done, touch wood, quite well financially. So it wasn't. We are more keen on building that business for the future.
It's very interesting to know. Such a pleasure speaking with you, Mr. Kaushal, today. Thank you so much for joining in with your insights and the outlook going forward. It was a pleasure.
Yeah, thanks, Sonal, and I wish you and your team all the best on this great day, and continue entertaining, providing information as you all do. Thank you.
All right, providing information indeed. That's what we do. Thank you, Sonal, for taking us through that conversation. The Nifty closer to that 26,100 mark. We take a short break, come back on the other side. The management of WakeFit Innovations. The public issue opens today. The management joins in on the other side to decode the growth prospects for the business. Chaitanya Ramalingagowda joins in.
"26 years of CNBC-TV18. 26 years of CNBC-TV18.
Welcome back. It is the season of primary issues, and this one comes in from the consumer durables, consumer use case space. It is that of a mattress, furniture and furnishings company Wakefit Innovations. Chaitanya Ramalingagowda, who's the promoter, executive director of the company, joins in. The near 1,300 crore IPO opens today, of which 900 crores is an offer for sale. Around 380 crores is fresh issue. Thanks a lot, Chaitanya, for joining in. You're seeking a market cap of nearly 6,400 crore rupees at the upper end of the issue price, which is pretty much similar to, the market cap of Sheela Foam, which obviously post the Kurlon listing has a market leadership position as well. So the one thing that the street would definitely like to know is a sustainable growth rate for the company. Over the last few years, your revenue has compounded at around 25%. What we want to understand, with the money that you will deploy towards building your company-owned, company-operated stores over the next couple of years, and the growth that you will have in alternate channels, etc., will this 25% sort of revenue growth sustain? If yes, if you could break that up into same-store sales growth, if you could break that up into channel-wise growth, and perhaps category-wise growth as well. I think you're on mute.
Sure.
Go ahead, Chaitanya.
Firstly, congratulations to you and the whole team for completing 26 years on this day. In terms of what you said about the Wakefit versus the industry, the one thing that I'd like to mention is that Wakefit is different from some of the listed peers, primarily because of the way it's grown up in different categories. For example, we are a multi-category company, which means mattresses is only one part of the overall business. Furniture has already grown to be about 30% of the business. Furnishing and decor is also 10% of the business. The second big differentiator is we are a vertically integrated full stack company, which means from research and development, manufacturing, engineering, supply chain, logistics, your own sales channel and brand, we own everything, which means there's no middlemen, nor are there contractors. So we source everything, manufacture everything, and hence we are a D2C brand. So we completely work with the customers directly. Good, bad feedback we take, we learn, and we iterate. So those are some of the major differentiators. But in terms of growth levers, all three categories are growing very steadily. Mattress is obviously the 11-year-old business, very, very steady, very mature, very profitable. And that is 60% of our overall numbers. Furniture, barely we entered about 3 to 4 years ago. That's already become 30%. Given the smaller base, it's growing way faster. Furnishing and decor also has crossed 100 crore mark. So all three businesses are scaled businesses. But when you put them all under one single umbrella, between our same store sales growth, online growth, we are confident of delivering a sustained number. In our industry, unlike a tech company, we're a tech-enabled real business with physical products, 5 factories.
Got it. Right. All right. Hi, Chaitanya. Good morning. Good to see you again. And hopefully 26 years later, your company is one of the top companies getting into the top indices as well. We wish you all the best on that front. But give us some more detail in terms of growth. As my colleague Mangalam asked, you can continue at this momentum. That would be mid-20s in terms of a percentage growth. And also, since you're both furniture as well as mattresses, what will an ideal mix look like? And what is the margin difference?
So in terms of growth rate, obviously, I cannot comment on a specific number, but
yeah. You can tell us whether the growth will continue at the similar momentum. That's par for the course. Regulators are okay with that.
Correct. You are absolutely right. Because we are not a tech company, we are a tech-enabled business. And so many physical moving parts are there. Any improvements that we bring, any growth channels that we bring has a sustained impact for a period of time. It's not a flash in the pan. So when our stores are opening at a pace of about 35 to 40 stores per year in a very sustained manner, that really, really compounds over a period of time because last year's stores become mature this year. Similarly, premiumization. We didn't have premium products 2.5, 3 years ago.
Right.
Today, in stores, nearly 30% of the product sold is premium. So those are the kind of secular trends that Wakefit is which gives us confidence that we can continue to keep the momentum.
All right. So revenue momentum continues. Just a final one before we let you go, because you're in the stock market now, the street will look at your margins and your earnings a lot more closely as well. And surprisingly, 1 half before your IPO, the EBITDA margins have jumped from 4.6% in FY25 to 11.9% in the first half of this year itself. What is a sustainable margin and profitability run rate that we should expect going forward?
We believe that there's a lot of juice left in the business, primarily because we are relatively new in one of the major categories, which is furniture. It's also profitable, but we believe the headroom there is much, much more, especially because it's a greenfield project. It's one of India's largest furniture factories. It's in Hosur, 50 kilometers from where I'm sitting. And that the ability to sweat that asset as the demand goes up, ability to sweat our warehouses and logistics as the demand goes up, there's a lot of headroom there in terms of margin improvement. And just to give you a sense, in the first 6 to 7 years of our existence, we were profitable. We went into the red only because of the greenfield project, and now we are back in profitability.
All right, Chaitanya, thank you so much for that. The street would take note of this on issue opening date. But mind you, both Nigel and I will be speaking to you on the listing day as well. And that time we'll press you a little more for questions and numbers. By then you will be able to answer a little more as well, and you'll be out of the regulatory lens. With that, what we'll do is take a short break and allow you to take that break as well. On the other side, we'll get you more on the markets and stock-specific action. Stay with us.
"26 years of CNBC-TV18. 26 years of CNBC-TV18.
Welcome back. As you can see, to the bottom of your screen.
Usually it's the top of the screen, but now it's the bottom of the screen.
Bottom of the screen. The Nifty is a little bit lower, Sensex a little bit lower, but the 20 DMA still continues to get defended, which is ballpark around the 26,000 on mark. It's our birthday, 26th birthday. We'll wrap up on Chartbusters. The team of Trading Hour is standing by. They come up next.
"26 years of CNBC-TV18.